Hello, this is Ben Anders. Welcome to the Tax Cuts and Jobs Act overview webinar. We actually presented this webinar earlier today, but the recording didn't work out and we had some technical difficulties. So I'm going to do it again, make it quick, and hopefully it'll be helpful to people out there. Unfortunately, my partners Terry and Denton, who had some great insight into the law, are not here today and into the tax planning implications, or they're not here right now. They were here earlier, but not currently, so you're just going to get my perspective. So here we go. Okay, the slide did not change, so hang on. There we go. Okay, we're going to start by talking about some of the things that affect individual taxpayers. There's the short list. We are not covering everything in the Tax Cuts and Jobs Act in this webinar. There's just too much, but these are some of the things that we see affecting our clients pretty often and things that people would be interested in. Then we will continue with some business provisions in the tax law, C corporation tax rate changes, depreciation changes, and so on. All right, starting with tax brackets. Essentially, the tax brackets are similar, but subtle changes that are lowering the tax rates for most income levels. And we do see people at very high income levels having a nice benefit. If you look at on the left, the 2018, that's how it would have been with the old law. Married filing jointly taxpayers who make about 420,000, 480,000 would be in the 35% tax bracket. Now, but on the edge of the 39.6, and now people who can make up to 600,000 are in the 35% tax bracket. And then, of course, the 39.6 bracket used to go on up forever, and now you'll be, if you're a really high income earner of over 600,000, you'll be in the 37% bracket. So that's that. Let me move on now. Okay, this slide is a little bit messed up, but essentially there, the standard deduction has changed. It has gone up dramatically for each filing type. So for married filing jointly, it used to be $13,000, and now it's going to be $24,000. So the standard deduction is a deduction that you can take if you don't itemize your deductions by putting a long list of all the deductions you claim, which I'm going to talk about next. So those have dramatically increased. Okay, itemized deductions. This is a long list of items you can deduct. One of the most common is state, in California at least, state and local taxes that you pay, because we all pay state income tax in California and property tax. This used to be fairly unlimited, and now it's going to be capped at $10,000 total between income tax you pay to the state and property taxes and any local taxes. So, and sales tax still counts if you want to deduct that instead of income tax, but the maximum is capped at $10,000. Mortgage interest, you used to be able to deduct mortgage interest on your first or second home up to $1 million, interest on up to $1 million of debt to purchase those homes, and now it's going to be only up to $750,000 of debt. Home equity lines of credit are no longer deductible, unfortunately. And then down at the bottom of the Schedule A, beyond the charitable contributions and everything else, you come to miscellaneous itemized deductions subject to the 2% floor. So this was a list of things that you could deduct to the extent that the total added up to above 2% of your adjusted gross income. These deductions have been completely taken away, almost completely. The popular deductions in this category were unreimbursed employee expenses, especially for like traveling salespeople who didn't get reimbursed for mileage. They might put it there. Tax prep fees for preparing your tax return, safe deposit box fees, and investment advisor fees can be pretty big if you have a large investment portfolio. Those items are no longer deductible. With some proactive tax planning, depending on your situation, you may be able to shift some of those expenses into your business and off of this list of itemized deductions where they probably shouldn't have been. Some of them shouldn't have been there anyway for the best tax benefit. For all you gamblers out there, gambling losses to the extent of your gambling winnings are still allowed to be deducted. So if you were itemizing before and you were way above the standard deduction of $24,000 for married or $12,000 for single, then you may still, but with that reduction of state and local income taxes and state and property taxes capped now at $10,000 max, a lot of people, their itemized deductions are not even going to add up to more than $24,000 or $12,000 for single, and so they're just going to take the standard deduction. Personal exemption was a deduction that in 2017, it was the equivalent of $4,150 per family member that was claimed on your tax return. It was nice if you had a family of 5, you'd get a $20,000 deduction, in addition to the standard deduction or itemized deductions we just talked about. This has now been repealed, taken away completely. With the slight change in the tax brackets, though, that makes up for some of this disappearance of this deduction. And also, the child tax credit has been increased. So if you have kids, it's gone up from $1,000 to $2,000 per kid under age 17, qualifying child under age 17. And the phase-out range has been increased significantly. So now you may be able to claim this even though your income is in a high, even though you're in a high income, you're a high income earner. There's a new dependent credit that did not previously exist of $500 per dependent, other qualifying dependent they're called. It's like if your mom lives with you and you support her, for example, that might be an example of that. Okay, moving on. Actually, if your child is over 16 and they live with you, I'm not sure if they would qualify for that dependent credit or not, but it's something to look into because you do get phased out of the child tax credit normally when your kids turn 17. Okay, long-term capital gains rates are staying fairly stable here. In fact, the rates are the same, 0%, 15%, and 20% max. But in the past, they were tied to your tax bracket, and now they're going to be tied to your income and indexed for inflation. So each year, those income numbers on the right, income level breakpoint, will rise a little bit. But still, long-term capital gains, long-term investments that last over a year before you sell them and take profit are a good way to keep your taxes low and still, make profit and grow your wealth. So for 2018, just looking at the chart here, if you were single, you know what I'm going to do here is actually going to see if I can use the drawing tool here. There we go. Single, and your income was $38,600 or less, and you had long-term capital gains, they'd be taxed at 0%. If you were single and your income was above $38,600 but below $425,800, then some of your gains would be taxed at 0% and some at 15%, and so on, with the max being 20%. So if you have investments, keep them longer than a year and sell them, you will be eligible for these long-term capital gains rates. Short-term capital gains are taxed at your ordinary income rate, which, going back a few slides, could be as high as 37%. So long-term capital gains definitely have a tax advantage over short-term capital gains. Okay, now on to the business items. The C corporation tax rate change. In the past, C corporations have had graduated tax rates very much like individual tax rates, and they used to go from 15 to 39% depending on the profit of the taxable profit of the C corporation. Now this has been converted to a flat 21% tax for all C corporations. It's obviously going to help some corporations that were being taxed above that, and hurt some that were taxed below 21%. So there's some tax planning opportunities here if you are a small business owner with a C corporation. You might want to consider an S corporation. There's a really neat deduction they just came up with for S corporations, which we'll talk about in a minute. All right, depreciation changes. And it says federal only on this screen. Remember that everything we're talking about today is really only for federal purposes. The state is not part of the Tax Cuts and Jobs Act. And you know what? I'm going to go back a few slides to itemized deductions, because even though the state is minimizing some of your itemized deductions, even though the federal government is the IRS, on the IRS tax return you file with the IRS, for the state, you may still be able to take some of these deductions. So still keep a list of your charitable donations, property taxes you pay, and so on. You may still itemize for state purposes. Okay, back to depreciation. Bonus depreciation has now, for the next 5 years, is going to be 100%. So if you buy a business asset, you can write it off completely in the first year. And the cool thing now is bonus depreciation used to be just for new property, but now it's for used property. So if you buy a used piece of equipment, for example, you could write it off 100% on the federal tax return through to in the year you place it in service, and this is good through 2022. After 2022, there are some reductions to that. I think it goes down to 50% and slowly phases out. But that, of course, assuming that they don't extend this or change, pass another tax bill. Section 179, a popular way to write stuff off. You can now expense up to $1 million in property used or new that you place in service in the current year. If you place more than $2.5 million of property in service in the current year, then you're going to be able to take less of a Section 179. I mean, you won't be able to take the deduction on the full $1 million. Take the full $1 million of deduction. So it kind of phases out after you put in $2,500,000 worth of equipment in service. This is now a permanent deduction. So the bonus depreciation, even though it kind of is going to fade away in the future, the Section 179 deduction of $1 million of property each year is going to be permanent, and it's going to be indexed to inflation. So it'll be a little more than $1 million next year, and so on. So these deductions are now essentially identical for the next 5 years. Small difference is California does not have a bonus depreciation deduction, but they do have a small 179 expense deduction of $25,000. Okay, passenger autos. If you use a passenger auto in your business, you will be able to deduct it faster, take depreciation more quickly than you could last year, and it rose by about $6,000 in your first year I think it was around 3,000 something. Now it's up to 9,000 something. Don't quote me on those numbers, but it definitely increased. And each year that you depreciate it, you can take more than you used to be able to. And then this part about real property, this does not refer to a rental property, like residential rental property. This is only for tenant improvements. So that would be like if you rented an office space and fixed it up. Restaurant improvements, if you rented a restaurant space and fixed it up. And landlord improvements to those kinds of essentially offices, restaurants, commercial spaces like that. If you do any of those improvements, you can deduct the cost of those improvements over a 15-year period. So it's 15-year depreciation now, which is shorter than what it was. So that's a bonus. Okay. Here are some miscellaneous business tax changes. This one's kind of sad because most small business owners love deducting their meals and entertainment. They've been able to take ski trips with their clients or boat trips or golf trips and take 50% of that as a deduction. Kings game, go to basketball games. It's the Kings here in Sacramento, but it could be the Lakers or wherever you're at. Well, that entertainment deduction is now gone completely, so theoretically no more golf trips, ski trips, and so on. I'm sure somebody will think of a creative way to get around that. Travel is still deductible, of course, business travel. And you can still deduct your meals. 50% deduction as it always has been. Well, I don't know about always, but in the recent past. Now, some of us like to, say, buy pizza for our employees to have a staff meeting and people could essentially work through lunch or dinner. And we used to be able to deduct 100% of that deduction because that was 100% deductible expense, but now that is going to be only a 50% deduction. So on this PowerPoint, that is the meals for the convenience of the employer. Okay, like-kind exchanges or 1031 exchanges refers to property that you want to get rid of it and you want to acquire a newer, better version of it. So when you sell it, you sell the first version of it, you might have some gain. Like, for example, you sell a single family rental that you had because you want to buy a duplex. If that property has gone up in value, you might have some gain. But if you did a like-kind exchange and went through an intermediary and made an exchange, so you never actually got any of the cash, you just applied it towards the purchase of the next building, then you could defer that gain until you sold the second building. You could then do it again and buy a 4-plex, an 8-plex, a 20-plex, a 100-plex, and so on up for the rest of your life if you wanted to, and there are tax benefits to doing that, and you would defer the taxes until you sold the very last building. Or if you died and those buildings passed to your children, the taxes would essentially go away. I'll explain that at another time. So the change to the tax law does not affect real property, real estate. You can still do like-kind exchanges for real estate. No problem. But it's no longer for vehicles or equipment. So that, vehicles and equipment that were used in your business. So if you trade in vehicles, every year or two, you might want to talk to your tax advisor right away, or equipment, because you may have some taxable gain on that transaction that you didn't used to have. Okay, the domestic production activities deduction is a deduction that businesses that manufacture things in the United States can take. Unfortunately, unfortunately it's now going away. So we used to take this for our dental clients that produced crowns or dentures in-house. We take it for our manufacturing clients. It was a very helpful deduction. Unfortunately, it's gone. Okay, here we go. On to the next one. Okay, this is probably the most exciting thing on this pack of slides. Hold on one second. Okay, this is called the deduction for qualified business income of pass-through entities. Maybe someday will be known as the Section 199A deduction. That's kind of technical talk. But if you are an owner of an S Corp or a partnership, a partner in a partnership, an LLC, and so on, you probably know that you have to file a tax return with the IRS showing the government how much profit the LLC made or the S Corp made, but that you actually end up paying the taxes on the profit on your personal income tax return. That's why they call it a pass-through entity. The profit is passed through to your personal income tax return. And then the tax is calculated there. So some examples of pass-through entities are S corporations, partnerships, LLCs, and for the purpose of this deduction, sole proprietorships, trusts and estates, rental properties, REITs, which is like publicly traded partnership that invests in real estate, and so on. There's probably a couple other things. The rental properties is pretty interesting because you could take this deduction if you have a gain on your personal rental properties that you just have on your individual tax return. REITs, you might get some dividends from, and you could take the deduction on that. If you're a sole proprietorship, you file your Schedule C with your tax return and you pay tax on the profit. You could get a deduction on the profit, off of the profit on that. Not off of your self-employment tax, but off of the regular profit, the income tax. So it's a 20% deduction off of domestic, meaning from the United States, qualified business income, meaning not capital gains and dividends or interest income, things like that, except in the case of the REITs that I just mentioned. And you can take the 20% deduction before calculating the taxes on your individual tax return. Here's a very simple example. You have an S Corp, your pass-through profit is $100,000. You can take a 20% deduction and only pay tax on $80,000 of that $100,000. That's a really good deal. But of course, there's a catch. The deduction may be limited by your personal income level. So if you are a high income earner with a married filing jointly tax return and your income is $315,000 or above, you got to get a little nervous because at $415,000 the deduction phases out completely. You don't get it. Any other filing status, if your income is above, this is your taxable income, not your total income, but your taxable income is above $157,500, then you got to be nervous because at $207,500 you lose the deduction. So of course there are exceptions, so let's talk about that. You may still qualify for the deduction even though it says you're going to lose it. Okay, if your business is not a service-based business, for example you're a manufacturing company, then even though your income might be above, let's say you're married, your income might be above $415,000, your taxable income on your individual tax return, you might still be able to take the deduction. Especially if you pay out a lot of wages in your business and or have a lot of depreciable property like equipment in the business. And we have one example of a customer that I know of right now. I'm sure there are more, but they pay out a lot of wages. I'd say they pay out $1 million or $2 million in wages. And there's still a lot, and even though they're way above the $415,000 income range for a married tax return, they can still take the deduction. So I can't go into the details about that right now, but if you are a non-service-based business, and you're a high income earner, talk to your do some tax planning right now. I think people that are going to be really in trouble with this would be a non-service-based business that does, say, online retailing, doesn't pay anybody any wages or very minimally, doesn't have any equipment, and is a high-income earner. Then I don't think there's probably going to be an exception for you, and you're not going to get the deduction. Okay, now service-based businesses. These are accountants, lawyers, dentists, doctors, veterinarians, what do they call it? Agents, you know, like for athletes, and perhaps even real estate agents, and on and on. Anybody who provides a service. If your income, I'm going back again, if your income is above $415,000 for married filing jointly, or above $207,000 for all others, I'm sorry, but you are phased out of the deduction, unless you are an architect or an engineer. You must have had some architects and engineers on the panel that created this new tax law, or maybe their lobbying efforts were very strong because they somehow carved out this exception for architects and engineers. Now there's another thing here, the next thing, the deduction is determined separately for each business and then combined. So what I'm trying to say there is that, let's say you have a rental property, a S corporation, and a sole proprietorship. You will determine the deduction, the 20% deduction on the profit from each of those activities, and then it will be combined together. Now, I haven't thought it through completely yet, but there may be some tax planning opportunities to shift income from one entity to another, depending on your situation. I do want to share one exciting achievement, I guess you could call it, that we did with one of our clients recently. Now, they were a C corporation, high income earners, two owners, two shareholders, and actually we were converting them to an S corporation because they were going to, down the road, prepare the business for sale, and they didn't want to pay double taxation on selling the business. They weren't going to sell the stock, they were going to sell the assets. They didn't want to pay, you know, I don't know if you know, but with C corporations, there's two levels of tax. First, the corporation pays the tax. Second, if you take the profits, sorry, let me start over. Corporation pays the tax on the profits. Second, if you take the profits out as dividends or wages, then you pay the profits. I mean, you pay another level of taxes. So that's double taxation. There's other reasons to have a C corp, but one reason to get out of a C corp is to avoid that double taxation. So what a lot of people do if they have a C corp is, in order to get the money out and avoid the double taxation, they pay a lot of it out in wages to the owners, leaving very little in the business. And then it used to be you'd be at the lowest business C corp tax rate of 15%, and you could get all the money out, and it would be taxed at your own tax rate. And so that's pretty similar to an S corp, the way it operates, with the tax being paid on your personal return. Okay, so here's the exciting thing. By converting this company to an S corporation, they are now able to lower their salaries. They kept them high to avoid the double taxation, but now they're able to lower their salaries, therefore increasing the profit left in the business. And it's not a service-based business, and they have high wages, so they're going to get the 20% deduction off of the profits. It's going to be huge. Also, because they're not paying so many wages, the amount of Medicare tax, the business and the individual, the shareholder, is going to go down. The Medicare tax that both parties has to pay is going to go down because the wages are lower and Medicare taxes are paid on wages. So it's going to be a big bang for their buck. I think their savings is going to be around $20,000 a year per shareholder. So very exciting. So the point is here, contact your tax advisor right away to find out about whether there are tax planning opportunities for you in regards to the Tax Cuts and Jobs Act. I believe that's the end of this webinar. Appreciate you listening. We are Innovative Solutions, CPAs and Advisors. We specialize in proactive planning with our clients. If you see our logo there and our motto, we like to listen to you, understand what you're trying to achieve, help you plan to achieve results, and then deliver outcomes, help you prosper. So please, you can find us on the web at innovativecpas.com. Have a great day. I really appreciate you listening, and I hope this has helped you. And I hope it encourages you to go talk to your tax advisor. Thank you very much. Bye-bye.